The IRS updated the tax code for 2026 and handed retirees up to $16,000 in combined deductions they have never had access to before. Most of them will miss it entirely because no one at the IRS is going to call and explain it. This video covers 3 overlapping tax breaks available to Americans 65 and older in 2026. They stack on top of each other. They apply whether you itemize or take the standard deduction. And for the right household, they can change whether your Social Security is taxable, whether your IRA withdrawal bumps you into a higher bracket, and how much of your retirement income the federal government actually touches. Here is what most retirees know. They know there is a standard deduction. They have been taking it for years. They assume their tax software or their preparer handles it automatically and they move on. That assumption is costing people real money in 2026 because there is now a third layer sitting on top of what most people already know about, and it did not exist before 2025. Congress created a new additional deduction of $6,000 per qualifying person age 65 or older. It runs from 2025 through 2028. It is separate from everything else already on the books, and it layers directly on top of the existing age-based standard deduction add-on that most people either forget about or do not fully understand. Walk through each one in order because the stacking is where the real money lives. The base standard deduction for a married couple filing jointly in 2026 is $32,200. For a single filer, it is $16,100. Those numbers are already higher than in prior years, but most retirees stop there and never look at what comes next. The second break is the existing age-based additional standard deduction. This one has been in the tax code for years, but a surprising number of filers either forget to claim it correctly or do not realize both spouses can claim it independently. For a married couple where both spouses are 65 or older, this adds approximately $2,000 more to the total deduction before the new senior deduction even enters the picture. The third break is the new one, $6,000 per qualifying person, age 65 or older, available from 2025 through 2028. For a married couple where both spouses qualify, that is $12,000 in additional deduction on top of everything else. A married couple, both age 65 or older, filing jointly in 2026, could be looking at a combined deduction ceiling approaching $46,000. That is not a planning trick. That is the law as written. Now here's the part most people skip, and skipping it is expensive. The new $6,000 senior deduction does not apply at full value to every retiree. It phases out based on modified adjusted gross income. And the phase out starts at income levels that are well within the middle class retirement range. For single filers, the phase out starts at $75,000 in modified adjusted gross income. That includes Social Security, IRA withdrawals, pension income, and any other income the IRS counts. It is fully gone at $175,000. For married couples filing jointly, the phase-out starts at $150,000 and disappears completely at $250,000. If your household income sits between those two numbers, you still get a partial deduction. That partial deduction is still worth claiming, and most people at that income level are not claiming it correctly. The retirees who benefit most are the ones with income below those lower thresholds. A widow living on $45,000 in combined Social Security and IRA withdrawals gets the full $6,000. A couple with $120,000 in combined retirement income gets the full $12,000. Those are real households, and that is real money left on the table if no one explains this to them. The deduction numbers are one thing. But what most retirees actually need to understand is what happens when those deductions collide with the income they are already drawing. Because that collision is where the tax savings become real and measurable. Two things happen when your total deductions rise high enough. First, your taxable income drops. Second, that lower taxable income can pull you below the thresholds where Social Security becomes taxable, or where an IRA withdrawal pushes you into a higher bracket. Both of those outcomes matter more than the deduction number itself. Social Security taxation is triggered by what the IRS calls combined income, which is your adjusted gross income plus any tax-exempt interest plus half of your Social Security benefits. When that combined income stays low enough, none of your Social Security is taxable. The deductions in this video do not directly reduce combined income, but they reduce what you ultimately owe on the income that does show up as taxable. And for households right on the edge of a bracket, that reduction can be the difference between a manageable tax bill and an unexpected one. IRA withdrawals are fully taxable as ordinary income. Every dollar you pull from a traditional IRA adds directly to your taxable income. When your deductions are low, a modest IRA withdrawal can push you into the next bracket. When your deductions are high, the same withdrawal gets absorbed before it hits the bracket threshold. That is exactly the scenario where stacking all three breaks in 2026 creates the most value. Put a real household against these numbers, and the mechanics become clear. Take a married couple, both age 65 or older, drawing $110,000 in combined income. That includes Social Security, IRA withdrawals, and a small pension. Their MAGI sits below the $150,000 joint phase-out threshold, so they qualify for the full $12,000 new senior deduction. Their total deduction stack reaches approximately $46,200. That means their $110,000 in gross income gets reduced to a taxable income somewhere around $63,800 before any other adjustments. Compare that to a couple in the same situation who missed the new senior deduction entirely. They walk away with $46,200 in deductions instead of $34,200. That is a $12,000 difference in taxable income at a 22% marginal rate. That is over $2,600 in actual tax saved. That is not a rounding error. That is a real check written to the IRS that did not have to be written. There is one more break sitting inside 2026 that most people either do not know about or assume does not apply to them because they have always taken the standard deduction. Starting in 2026, certain standard deduction filers can claim a deduction for charitable contributions on top of the standard deduction. The amount ranges up to $1,000 for single filers and up to $2,000 for married couples filing jointly. It is not unlimited, and it requires that the giving go to qualifying organizations. But the point is this: you do not have to own a home with a large mortgage, you do not have to itemize, and you do not have to be wealthy to use it. For a retiree who donates regularly to a church, a food bank, or any other qualifying nonprofit, this is free money that was not available before. Stack it on top of the three breaks already covered, and the total deduction picture in 2026 is unlike anything this age group has had access to before. The full stack available to a qualifying married couple in 2026 can exceed $48,000 in combined deductions. That number would have been unthinkable 5 years ago. Here is something worth sitting with. Every one of these deductions is legal. Every one of them is in the published tax code. The IRS knows about them. And the IRS will not send you a letter explaining that you left $12,000 on the table. The IRS is not your tax planner. It processes the return you submit. If you miss a deduction, the agency does not flag it and issue a correction. It collects what you send. That is the entire relationship. The new senior deduction has a hard expiration. It runs from 2025 through 2028, and nothing currently in law extends it beyond that. Miss these 4 years and the opportunity is gone. There is no retroactive fix, no amended return years later that recovers a deduction you simply failed to claim on time. That is a 4-year window. Most retirees watching this are already inside it and do not know it. One more piece of this picture rarely gets mentioned in the same conversation as deductions and brackets. For retirees who are also thinking about what they leave behind, 2026 is an unusual year for a different reason entirely. The federal estate tax basic exclusion amount for 2026 is $15 million per individual. For a married couple using portability, that figure effectively doubles. This is relevant to retirees who have built meaningful assets over decades because the decisions made now about income and deductions can directly affect what transfers to heirs and how much of it survives the tax system. When you reduce your annual tax bill by stacking deductions correctly, you preserve more of your retirement assets each year. Compounded over several years of retirement, that difference accumulates. The retirees who claim every available deduction consistently are the ones who arrive at the end of their retirement with more to leave behind, not because they invested differently, but because they stopped giving the IRS money they did not legally owe. For households well below the $15 million threshold, The estate tax exemption itself is not the pressing concern. What matters is the discipline of reducing taxable income every single year so that retirement savings last longer and transfer more cleanly. These 3 breaks in 2026 are part of that discipline. None of this helps you if it stays theoretical. Here is the practical checklist before your 2026 return gets filed. First, confirm that you or your spouse meet the age 65 threshold for every break being claimed. The age-based add-on and the new senior deduction both require it, and both spouses must individually qualify for the full joint amounts. Second, calculate your modified adjusted gross income before assuming you receive the full deduction. If your income is anywhere near the phase-out thresholds, a small shift in how you time an IRA withdrawal or manage other income in 2026 could preserve the full deduction versus losing part of it. That timing decision is worth running before December 31st, not after. Third, do not assume your tax preparer is proactively looking for this. Most preparers are competent and honest. They are also working from what you hand them. If you do not ask specifically about the new senior deduction, the age-based add-on, and the charitable deduction for standard filers, there is a reasonable chance all 3 sit unclaimed on a return that gets filed and accepted without them. The return gets accepted either way. The IRS does not reject a return because you left a deduction unclaimed. It just keeps the money. That number is conservative. For couples with income structured to maximize all 4 layers of deductions, the actual savings can run higher. The point is not to chase a specific figure. The point is to stop paying taxes you do not legally owe, starting with the return you file for 2026. Pull up your 2026 return, confirm these 4 deductions apply to your household, and file the most accurate return you have ever filed. That is the whole job. If you found this useful, there is a new video on this channel every day covering exactly this kind of information: the tax rules, the retirement income traps, and the planning decisions that most people never hear about until it is too late to act on them. Subscribe so you do not miss one.